Here with Alex Brown, partner, CFP, recovering accountant. He's a CPA. And Alex, let's talk for a moment about returns. Because you hear people talking about, I got 10% last year, but those numbers really don't tell the whole story, do they?
No, they don't. Market return, which is what most people focus on, it really is insignificant when you think about the fact that at the end of the day, what ends up in your pocket is after taxes. And then what that dollar that is in your pocket can buy is all based upon what the current value of goods at that point in time. And so we often forget about taxes and inflation. And taxes for me is a big thing because, as you know, as a recovering accountant, I like to focus on that piece because market returns we can't control. The market will adjust from day to day, but taxes are predictable. We sort of know what they're going to be, and we can control that by how we decide to invest the assets. That you have the ability to invest your money in IRA accounts, into taxable accounts, even Roth accounts. And it's really important in retirement that you really have that ability to have those assets both in all of those forms of accounts, because when you're in retirement, it's the one time in your life you'll be able to dictate your own income. You'll be able to pull out your little tax table and say, today, what is it that I want to make or what I want to recognize in income? And you're going to decide that based upon whether you want to use taxable accounts, whether you want to use those IRA accounts, or whether you want to use the Roth accounts. And you're going to be very careful to make sure that you don't recognize any more taxes than you need to. And so when you think about the fact that the federal tax rate's at 35%, states, a little bit short of 10%, 45% in taxes potentially can really eat up those returns. And when you can control that by the way that you invest your assets is an important piece.
And of course, the inflation part, even more important with regard to fixed income. Because if you just think to yourself, well, I'm going to invest money for 5 or 10 years at 3 or 4%.
Absolutely.
Well, that's fine when inflation's less than 1%.
Yeah.
But if suddenly inflation pops up to 3 or 4%, what's your real return?
Yeah, absolutely. I mean, right now people are very happy and have been for some time about, 3 to 4% returns if they can get that. But when you think about the fact that inflation over long periods of time is right about 3-4%, I mean, the reality is that while they're protecting the dollar, they're not actually gaining anything. And so inflation is actually going to become a bigger issue for many people. And the sad thing about it is people are still struggling with, the market debacle of 2008. I mean, people are still hesitant to get back into the market. And the reality is that when inflation starts to peak around the corner, they're going to be forced to push themselves back into taking more risk in order to protect the dollars that they have, in order to be able to continue to buy the same things that they've always purchased to keep up with inflation. And so they're going to be forced to take more risk. And that's going to be an unfortunate circumstance at that point in time. Today, most people in retirement are happy clipping the coupons. I mean, for the most part, they're not affected by the inflationary bug, with the exception of maybe those who are taking long commutes, which are going to feel the effects of oil prices. But right now, the retirees are actually doing well. But if inflation starts to peak around the corner, that's going to be devastating for them. And unfortunately, they're going to have to start taking more risk in order to keep up with the value of the dollar.